This presentation gives you a quick view of Basel II, which is a set of banking regulations prescribed by the Basel Committee on Banking Supervision. I am Pat Obi, Professor of Finance at the Calumet campus of Purdue University. The Basel Committee comprises the banking regulators from about 27 countries, and the committee, what it does is to recommend guidelines for a common set of standards for bank supervision and, more importantly, risk management. In Basel II, though, they identified 3 pillars within which to evaluate the performance of banks. Pillar number 1 deals with the minimum capital that will be required for each financial institution. Pillar number 2 deals with supervisory review process, and pillar number 3 deals with market discipline. These will be explained in the next set of slides. The key goal of Basel II, though, is first and foremost to determine how much capital that banks should have in place given the types of risks that they face in their lending and investment activities. Now keep in mind that when we say capital here, we are referring to how much investment the owners of the bank should have in that bank for them to successfully operate the business. So the amount of money that the owners of the bank have in their business is referred to as equity capital. And so, in addition to that equity capital, we're also going to be considering additional ways of obtaining funds in order to keep the banking business in successful operation. So, to help you understand the import of this argument, consider this illustration here. This gentleman on my right side wishes to borrow money. He goes to this bank to borrow, and the amount to borrow is $100. So this bank is about to make a loan for $100, and of course the bank needs to make loans so as to make income, so as to make money. So he's going to lend this guy $100, which this guy is probably going to use to purchase real estate if it is a home loan type of credit, or probably invested in his business if it is a commercial type of loan. But you see, though, banks do not grow money on trees, as even our great-grandparents would tell us. And the way that banks make money is, of course, from the deposits that bank customers over here on my left side make in the bank. These deposits are in the form of savings and checking accounts and other time deposits. So let's say that altogether these fine folks on my left side deposit $100 into their various accounts. Now, armed with the $100, this bank is able to make this loan to this business on my right side. Unfortunately, upon the maturity of the loan, this guy is unable to pay back the entire amount. He defaults to the tune of $5, let's say. So he kind of frittered away $5 and is only able to pay back $95. So we have a situation here. This guy has less than the $100 that he got from his customers. What is he going to do? Turn around and tell his customers, his deposit customers, sorry guys, I'm unable to pay you back your $100. I can only give you 95. Now, if that were to happen, then I tell you what, these guys would more than likely pull the rest of their money out of this bank, because they'll be afraid that there would be more disasters to come in the future. And of course, if the word gets around, depositors at other banks may follow suit. And so what we have is called a bank run. And that bank run has now resulted in a contagion. That contagion, if it persists, turns into a financial crisis. And as you know, governments wouldn't like that. So here's Uncle Sam right here. So governments thinks, well, what are we going to do to make sure that we don't have a collapse in our financial services industry? One way, of course, is to put in place a set of guidelines to assure these depositors that they're not going to lose their money regardless of how imprudent this bank performs in its lending activities. In the United States, one way that that has been assured is by including the Federal Deposit Insurance Corporation as part of the Banking Act of 1933. The FDIC, what it does is to insure the deposits of these customers so that regardless of how successful or not this bank is, these guys at least would know for sure that they're going to get their money back. But you see, that only serves to assure these depositors. It doesn't quite correct the underlying problem, which is the riskiness of these banks' lending practices. So I suppose there's a couple of things that the government can do. One way is to try and bail out this bank. The government can give this bank $5 so that this bank gets all its money back and continue in business. There is a public policy benefit to that because governments should not want their banks to be collapsing. If too many of that happens, again, that becomes a systemic problem, and that's going to cause a loss of consumer and investor confidence. But you see, though, by governments bailing out a bank, it means that the government is going to use taxpayer dollars to bail out banks. And as you know, many people are offended by that because you are now making the taxpayers to be the heavy for the wrongs committed by this bank. Alternatively, however, this government can say to the bank, well, by the way, who owns you? Well, it so happens that the guy who owns the bank is this big fella out here. So this big fella out here, government looks at him and says, hey guy, you shouldn't really be beating up on little kids. We're going to have you put a good skin on this in this game. If you want to play big, then you're going to have to act big. So if you want to keep running this bank, then we're going to have to require that you invest a sufficient amount of your money, your capital, in this bank to absorb the risks that your bank takes in its lending practices. So, for example, the bank regulators, which are government regulators, might come in and institute a rule that for this guy to keep this bank running, that it has to invest at least 8% of the size of the loan that this bank makes. In effect, 8% of $100, which is $8, would represent the minimum capital investment that this big fella here would have to make in this bank. So that if it turns out, for example, that this bank's borrowing customer loses $5, this loss would have to be absorbed not by the depositors, not by taxpayers, but rather by this big fella out here. So that would cause his $8 investment to drop to $3, having absorbed the $5 loss. So that kind of sets the stage for the type of prudential bank supervision that Basel II seeks. But there are a couple of things that have to be ironed out here. First of all, how do we determine before the facts how much equity capital that this big guy needs to have prior to this bank even conducting any businesses in the future? And second of all, should we then require all banks out there to also put down 8% of whatever the amount of loans that they have made? In other words, should we use the same paintbrush to paint everybody in this line of business? Well, to answer those two questions, let's consider this second set of illustrations. Again, we have our bank here on the left side who's about to make a $100 loan to this fella out here on the right side. Now, we already have determined that this guy here is a high-risk borrower, and so there's a high likelihood of defaults. Now, as a result, we have determined, for example, that the bank owner should invest at least 8% of this loan so as to ensure that any losses would be well absorbed. So in essence, we summarize here, if a bank engages in high-risk loan, then a larger amount of capital would have to be required to ensure that the bank is able to absorb all financial risk losses. Now, on the other hand, if we have a similar bank out here, I mean, they really are the same. They're about to lend the same amount of money. However, this second bank down here, which although it looks like the first one, is about to make the same size of loan but to a low risk business. This fella out here on the right side is a good tradesman. He works hard in his job, he makes good money, and therefore the $100 he borrows from this bank, he is sure to pay it back. And so there is a very low likelihood of default in this case. So what regulators would then do is to say, well, now we're going to have to evaluate how much equity capital that the owners of the banks would make given the riskiness of the loans that they make. So we're going to have to weight each of these loans by the riskiness of the loans that are extended to these two borrowers. This top borrower right here, there's a high likelihood of default, and so we're going to base 8% on 100% of this loan amount. On the other hand, we could, based on the fact that this guy is low risk, base the 8% that the owners of this bank would have to invest on only 50% of this loan amount of 100. Well, as you can see, 50% of 100 is $50, and then 8% of that $50 would be equal to $4, so that the owners of this bank would only need to invest at least $4 to keep their bank operating, because we judge that $4 is sufficient to absorb the very, very low risk associated with the type of businesses that this bank does. While in this case, all of the loans that it makes would have to be considered in determining the minimum amount of equity that the owners of the bank should maintain in the bank. So going back here, we summarize: the riskiness of all investments made by a bank is considered when determining the capital requirements from the owners of the banking business. In essence, the greater the risk, the greater would be the amount of capital that would be required to support the bank's overall activities. So now, the goals of Basel II in that light are summarized as follows. The first and foremost is to make regulatory capital more risk sensitive. Regulatory capital would be the $8 that will be required for this first bank here, and the $4 that will be required by this second bank here. Those numbers are based on regulation. Number two is to promote enhanced risk management practices among large internationally active banks, because those are the too big to fail institutions. And thirdly, to improve the consistency of bank capital requirements internationally, so we can have a common basis to evaluate financial institutions from one country to another within this era of globalization. The three pillars of Basel II, as I mentioned earlier, are again summarized here: minimum capital requirements, supervisory review, and market discipline. But back to this pillar number one, what it then prescribes is that the minimum capital requirement, which is the minimum amount of capital that the owners of the bank should have, should not only reflect the credit risk of the activities of the bank, credit risk meaning the risk of default on a loan by the borrowing customers, as we have shown in the illustrations, but also should reflect the market risk associated with the bank's other financial transactions, such as engaging in the sale of stocks, bonds, etc., etc. I will talk about these some more a little later. And also now in Basel II, operational risk has to be considered in determining the amount of capital that investors should have. Operational risk factors are non-financial. They are like the risk of theft, of natural disaster, of a breakdown in information technology. While these are non-financial risk factors, they also can lead to financial loss in the operations of the bank, and as a result ought to be considered in determining the minimum capital requirements. So in this pillar number one, here's the specification that minimum required capital should in fact be 8% of not just total assets but of risk-weighted assets, as I have just explained. And the risk-weighted assets have to reflect credit risk, market risk, and operational risk. So for example, if credit risk-weighted assets of a bank amounts to $100, and the combination of market risk-weighted assets and operational risk-weighted assets amount to also $100, then the total amount of assets that would have to be used to determine how much capital that the bank should have would now be 8% of 200. 8% of 200 is 16. So if these are in millions, that will be $16 million would have to be the minimum equity dollars that should be had by the bank as its capital. And as we also have learned, the minimum equity capital, the minimum capital for credit risk has to reflect the credit ratings of the counterparties. In other words, if I go back here, it has to reflect the credit rating of this guy here and this guy here. If your credit rating is high, as in this guy at the bottom, then you are low risk. If your credit rating is low, as in the guy up top here, then we're going to have to require more capital. You got to have more skin in the game to run such a bank. So now, the minimum capital requirement for market risk would be based on the 96 Basel amendments, which I will explain shortly, while the new capital charge for operational risk is now introduced in Basel II. But before we get to market risk, here's a general example of how the credit risk weighting of assets under Basel recommendation goes. So let's consider a simple case where a bank assets are in these forms. The bank has cash of $1675, federal funds sold of $550. Federal funds sold is actually interbank loans, loans made to another bank or other banks. Home loans are residential loans made to individuals, $2,500. Commercial loans, $4,000. Municipal bonds, 1,000. Municipal bonds are part of the bank's investment portfolio. So these are bonds of local governments that the bank has purchased and from which it earns interest income. And then there are property, plants, and equipment, premises, other assets, 200 and 150 respectively. So now for total assets of 10,000 and 75. So here's what's up. We're going to have to do risk weighting from 0% to 100%. In other words, we would assign a weight of 0% to an asset item that we know for sure there is no risk of loss, and assign a rating of 100% to an asset item we know has a 100% chance, so to speak, actually, of being lost. And by the way, you can also have a risk weighting of more than 100%. In other words, the odds of loss are actually a whole lot more than would be the case if it were just simply 100%. So now, what we've done here is to say, well, cash is really money in the vault of the bank. There's no chance of it being lost. I mean, really. And so it has a risk weight of 0. On the other hand, this in a bank loan of $550, we kind of assign a risk weight of 20%. So there's a low likelihood of loss, but there is some elements of loss still there. For home loans, we kick it up to 50%, 50% chance of loss, so to speak. Municipal bonds, we leave it at 20%, depending on the credit rating of the local governments from whom you purchased these bonds. And then for these two last guys right here, we place them out here under 100%. So here we go. To determine risk-weighted assets, we're going to say, well, how many assets, how much do we have under risk weighting of 0? In this example, 1675. So 0% of 1675 would be 0. We need not require any capital for this guy, for this one right here. On the other hand, for the total assets under risk weighting of 20% is 1550, which is the sum of these two. If we multiply 1550 by 0.2, as I show here in this one example, we have 310. So in other words, the 8% would have to be based on 310 of this risk-weighted total right here. Likewise, for 50%, we determine it to be 1250, and for 100% it's going to be all of this would have to be recognized. So if you add up all of these numbers, you get 5910. And so in determining the capital requirement for this bank, we're going to say, well, the minimum capital would have to be 8%, not of 10,075, but rather 8% of 5,910, which is what I show here, and that comes out to be about 473. So a minimum of $473 would have to be the capital required of those who own this institution. Now, for market risk, what we do here is to recognize all the instruments that the bank may trade in as part of its general financial transactions. As you know, some banks engage in the trading of stocks, bonds, commodities, other interest-bearing instruments, and even foreign currencies. And to the extent that a financial institution trades in these instruments, there is bound to be some element of price volatility. Price volatility means that prices could fluctuate on the downside and you lose money. So there is a risk of loss. So these financial instruments we note here include what in banking parlance is referred to as trading book items, as well as off-balance sheet items. Trading book items are those financial instruments that the bank directly buys and sells to make additional money. They include derivatives, marketable securities, foreign currencies, commodities, stocks, bonds, and so forth. Now, off-balance sheet items are tricky. You see, many financial institutions engage in various financial transactions that are not explicitly shown on their books. However, those financial transactions have the capacity to also result in a financial loss as much as they can also make money for the bank. For example, when a bank issues a letter of credit accepting liability if the merchant doesn't pay, of course, the reason that the bank would issue such a letter of credit is because the merchant gets to pay fees and interest, for such a letter of credit to be furnished. But as you know, if that merchant were to default, then the bank becomes the heavy, so there is a risk of loss. And as a result, in also determining capital requirements for market risk, we include off-balance sheet items that the bank transacts in. So it's not just those that are explicitly listed here, but also those that are not explicitly shown on the bank's financial records. Here's an example of how market risk capital can be calculated, and this is based on one of several models introduced out there. This is called the internal model approach, where you would multiply a multiplicative factor here, k, which is a number equal to 3 or larger, as I explained here, by the value at risk. Value at risk is the maximum amount of money that a financial institution can lose within a defined period of time, given a certain likelihood of it occurring. Now then, specific risk charge, SRC, here represents an additional amount of money that the bank should also include in this calculation to reflect any unique risk factors that the bank is exposed to in whatever way that the bank chooses to evaluate that. So in a different presentation on risk management, I show the various ways to calculate value at risk. So let's say, for example, you determine the value at risk of a bank or any institution for that matter to be equal to $10 million for 10 days. So you say, as a result, that the maximum amount of loss that this bank can experience over a 10-day period is $10 million. And you may have used, say, a probability of 99.9% confidence level to establish that, meaning there's only a 0.1% chance of exceeding that loss of 10 million, which is very tiny and almost insignificant. So if your VAR is 10 million and your K is equal to 3, then 3 times 10 would be 30. And if your specific risk charge is $1 million, then the total capital requirement here would have to be $31 million. So $31 million, I show it down here. 3 times 10 is 30, plus 1 is 31. 8% of that 31 means that the amount of capital that should be required for this institution would have to be about 2.5, which is 8% of 31. Now, therefore, based on the 96 Basel Amendment, the total capital required would not only include credit risk capital, but also market risk capital. So that the 8% that is being required here would be 8% of credit risk weighted assets plus market risk weighted assets. So these two would have to be combined, as in this example. So if we go back and take this 5910, which is the total credit risk weighted assets, and add that to this 31 million right here, which is our market risk weighted assets, then 8% of the total of the two would come out to be a little over 475 would be the equity, would be the capital requirements for this financial institution. But now, moving into Basel II, we introduce operational risks as well, so that now we extend the model to be 8% of not only credit risk weighted assets and market risk weighted assets, but also additionally operational risk weighted assets. The specific ways that these are calculated are widely discussed in the literature as well as in textbooks dealing with risk management. But though, what are the capital components when we say capital that are really required under Basel II? Well, specifically, what they've done is to identify two tiers of capital, Tier 1 and Tier 2. Tier 1 capital is common equity of the bank, which is the real investments owned by those who own the bank. The investments made by those actually who own the bank, and that'll include their original stock investments plus any accumulated retained earnings. Additionally, we have to include non-redeemable, non-cumulative preferred stock because this type of preferred stock is pretty much the same as a common stock. Tier 2 would be other types of preferred stock in addition to various types of long-term debt. Now, it does require that at least 1/2 of the 8% required would come from Tier 1. In other words, at least 4% would come from Tier 1, 4% of risk-weighted assets. Pillar 2 deals with supervisory review. What it does is to allow regulators the discretion to consider local conditions in the way they implement the Basel rules. And in this, they establish 4 key principles. The first is that the bank itself should have a process for assessing their own capital adequacy. The second one is that supervisors, and by supervisors we mean regulators, should be able to review and evaluate the bank's internal capital adequacy assessments and strategies to make sure that it is kosher. Thirdly, that supervisors should expect banks to operate above the minimum required. So if the minimum required is 8%, while we shouldn't expect banks to go below it, banks should feel free to go above it, kick it up to say 10%, just to allow themselves wiggle room. Of course, that places greater tax on the investors of the bank, but also that keeps the banking system safer. And fourthly, and most importantly perhaps, that supervisors should intervene at an early stage to ensure that all bodes well in paradise. Pillar number 3, the third and final one, requires banks to fully disclose their risk assessment procedures and capital adequacy. Now, but what this does is to require banks to be more diligent in disclosing information, in making sure that all stakeholders are fully aware of how prudent they conduct their businesses. Stakeholders include government regulators, those who own the bank, and definitely the depositors who place their money in the care of these banks. So this is a wrap on Basel II. I am Pat Obi, Purdue University, Calumet.